Well, I'd like to welcome everybody here today. I'm going to go very quickly. I have a lot of material to go through in 19 minutes. We went a little long there last time, so I'm going to try to get through it quickly. If you're not familiar with Keystone, we provide independent research. Charday is going to hand out to you some information on our company. By independent, I mean I'm going to recommend stocks today. We don't get paid by the companies that I'll be talking about today. We only get paid by our clients. So we think it's the best model. The only way we make money long term is if we make our clients money long term. And you can look at the brochure to see exactly what we do. So I'm going to ask you today, why are we here? Why do you come to events like this? Well, the main thing is you're here to make money. And I like making money, and I'm sure you like making money. But you should also be here to avoid losing money.
For the best editorial on junior mining, visit cambridgehouse.com/mining. Click the link in the description below to learn more.
And it's one thing that I think people do not pay enough attention to. So I'm going to go today through some simple strategies that'll help you avoid losing money, and also some actionable recommendations, 3 to 5, depending on how much time we have today, on how to make some money. Now, I'm not sure after what I say here next if I'll be asked to come back here and speak next year, but I have to tell you that I have to be honest when I give these speeches. And I'm just going to tell you, it's our opinion that the junior mining sector is a terrible place to make money long term. And I'm going to stress long term when I say that. And wait, you're going to say, okay, well, you know, we all have this story from our cousin's uncle's former roommate that bought ABC Explorer Co. at 10 cents, and it skyrocketed to 10 minutes later to $10 after they find the greatest gold mine of all time on the 7th moon of Endor, probably. But that hope that you find in that sustains you, and that's why you come to these events, we think. But I'm here today to extinguish that hope. Now, I could go on about the lack of business models in the sector, the lack of cash flow, which actually drives shares long term. But let's not do that. That's boring. Let's just look at the returns in this segment long term. And how are we going to do that? Because if it was a great place to put your money, then wouldn't there be great returns in this segment long term? Well, let's see. We're going to use the TSX Venture as a proxy for the junior mining segment.
For the best editorial on junior mining, visit cambridgehouse.com/mining. Click the link in the description below to learn more.
Because if you can see on here, about 60% of the listed companies on the TSX Venture are mining. You can see there, it's about 971 of the 1,700, and that's actually down over the last several years, are mining-related stocks. So it's a pretty good proxy for the mining segment. I would actually argue that the index itself understates the poor long-term performance of junior mining and exploration companies, because there are some good companies on the exchange that are actually pulling up the returns, and they're not in this segment. And we'll go over some of those good companies and hopefully help you make some money in them. So how well is the TSX Venture performing? Well, let's look at what it did last year. That's pretty pathetic, I'm just going to say. 34.5%, not so good. But it was a weak year overall, was it not? There was a risk-off trade, particularly at the end of the year. We saw that in the small cap sector. So how did it fare against other indexes? And if you look at this chart, that'll show you. The bottom line there is the TSX Venture. That's against the S&P 500, the Dow, all major indexes, even the Shanghai and the Shenzhen in China. Absolutely last is what it ranked last year. That's pretty pathetic once again. Now let's look back 3 years. What has it done over the past 3 years as a proxy for the mining segment? It's down 43%. Again, that is not a good performance. How about from its highs in 2007, 2008? What has it done over that period? The exchange itself, the entire exchange, is down 81%. That's astounding. Exchanges are supposed to be creators of wealth over the long term, not checking off those boxes there. I don't know who is putting the money in this exchange that boosted it up to the level of 6,000 or 5,000 at one point. I have no idea, but I would advise against it. Now let's look long term. Since inception, since the exchange was created, how well has it performed over this period of time, 2001, 2002? That's when it was created. It is down 40%, the entire exchange, over that period of time. This is not how an exchange is supposed to perform. Now, I'll give you a good example of long-term how an exchange is supposed to perform. That is the S&P 500 since inception. This is creation of wealth in the stock market over time. Great companies, innovation, this is what you see in an index like that. That's what we should see in our venture exchange. We don't. Our TSX, creator of wealth over time. It's great to see that it's doing that. But why doesn't the TSX venture create value long term? It's very simple. And I already stated this. The primary constituents in this exchange are junior mining companies. And that is why it has not created value over the long term. Now, but alas, you're all here gathered today, right, to find the next 10-bagger in the resource sector. Now, I was going to reference some great junior mining stock, but I racked my brain. Bre-X came to mind, but that didn't work out so well, did it? Why could I not find any great junior mining stock over the long term? Because they don't exist. It's like chasing unicorns. The only place unicorns exist are in my 3-year-old daughter's room, and if anybody in the room tells her any different, we've got a problem, but that's an aside. But they don't exist in the mining sector. So gold, platinum, uranium, lithium, you hear all about this at these conferences. The great next deposit from all these conspiracy theories. It all can sound sexy and make a lot of great headlines. Look, I get it. When I was in university, I came to a conference like this, and I tried my hand at the sector. I thought, I'd avoid doing some summer job, menial task in the summer to make money. So I put my money in there to try to double it over the summer. Suffice it to say, I worked long and hard that summer to make up for those losses. The bright side is it pushed me to find a better way. There has to be a better way. And I'm here to tell you, there is a better way. You can make those type of blue sky, 10-bagger type returns that you are looking to make. You can do it with less risk, and you can pay less fees, creating a sustainable portfolio over time. Now, if that doesn't sound like an infomercial, what does? But I'm here to give you proof that we can do it. Now, in fact, just over a year ago at a Cambridge show, the Extraordinary Future show, Keystone recommended a stock, one of the most boring, uninteresting businesses out there, and it turned out to be one of the single best performing stocks in Canada over the past year. And I'm going to get into that company in a second. Now let's look at some of these boring businesses that can actually make you the money that you're trying to do. I'm going to give some audience participation. Now, I did this in Toronto. Not a single person got it. I've done it at a couple events here in Vancouver, and more people have got it, which is excellent. The single best performing stock on the TSX over the past 10 years. Can anybody name it? Oh, come on, I have faith in you. Right? Oh, there we go. In Vancouver, we understand. We get it. Yes. Boyd Auto Body Group. Around 5,700%. What do? Nothing sexy at all. Doesn't make any headlines. They fix cars, automobile repair, and glass. That's what they do. But the returns over the past decade have been absolutely tremendous, besting all other company in Canada on any exchange. Now, the stock, if you would have put $20,000 in this company 10 years ago, you'd have $1.15 million today. And that's what we are all looking to do. Boring business made you a millionaire, and that's what we're trying to prove today can happen. But back in 2008, you'll say, we didn't have blockchain, we didn't have cryptocurrencies, IoT, cannabis. Cannabis was only a pipe dream at that point, and that's pun intended. So if you fast forward to the start of 2008, when cannabis stocks are all over the news, cryptocurrencies, blockchain were the talk of investors everywhere, can anyone tell me one of the best performing non-penny stocks in Canada last year, 2018? You're not alone if you don't know the name of this company. Expel Technologies, Inc., up 320%. This is the company that I was talking about that we recommended at Extraordinary Future about a year ago. Now, what do? It's another absolutely boring business. It really couldn't get more boring. They provide and install automotive film that helps prevent those annoying scratches and dings you get on your car. Now, what has driven this stock? Absolutely tremendous performance and underlying cash flow. That's what will drive a stock long term, not headlines. Now, finally, I have a final question for you here. Name one of the worst performing stocks in Canada in 2018. This stock made tons of headlines at the end of 2017 and into 2018. I'll give you a hint here. Does anybody know the company? Right here, Hive Blockchain. 2018 down approximately 90%. Now, at the start of 2017, 2018, our clients were coming to us, many people were talking to us, we need to be in on blockchain, we need to be in on cryptocurrency. We're happy to say we've never recommended a stock in this segment. We looked at every company in this segment in Canada. Not a single one was profitable, so it wouldn't meet our initial criteria. We avoided the sector. Now, Hive is not alone in the sector. The average loss in that segment of the, I think it's 26 companies that are traded in North America, was 82% last year. So Hive underperformed that. That's impressive, but 82% on average. It just is a very cautionary tale to not follow the headlines. It can serve as a great example of why following the herd, going in the hottest segments, can be a recipe for disaster for your portfolio. Like I said, we've never recommended a company in this segment because it does not fit our criteria. There's no cash flow here. A couple of stocks that we have recommended are Boyd and Expel. Those are the type of companies that we like to invest in long-term to make you money. Now, my advice and our advice to you today is to stop trading stocks like their symbols and buying them on hype and headlines, and begin looking at them as a business, not just a symbol or a headline. Now, I mean, you should understand this, but we need to be reminded of this. A stock is an ownership interest in an underlying business. It's not just XYZ or ABC. It is a business, and when you buy a business, you want to buy a company that is profitable, creating cash flow over time. That's what we like to do. Invest like you're an owner. Profitability should be the minimum criteria long term. So what we want you to do is take control, create your own simple equity portfolio. How many stocks should you own? 10 to 20. We don't want you owning 100 stocks in your portfolio because you just become the market and you underperform it because you pay a ton of fees in that type of portfolio. 10 to 20 stocks. Select from a variety of sectors so you have some level of diversification. You can't have 10 technology or 10 mining. We wouldn't suggest many in that segment. If one does poorly, and one company or one or two in your portfolio will do poorly. Anybody who tells you that every company is going to outperform long term, you should leave the room if somebody tries to tell you that. 2 of them are average, or 3 are average, 2 above average, and you get a couple companies in there like Expel or Boyd, it can pull up your returns over the long term. Now, buy that over a 6 to 18 month period. If you came to me today and said, give me the 10 stocks, I'm really excited, I want those, I can't give you 10 stocks to buy today, but if you give us a year to do our research, we will buy you those and get you those recommendations on those 10 stocks. The first company I'm going to look at today is Expel Inc. Tremendous year last year, but it still offers value today. It's trading around $5.50. It's moved off a little bit. It's a great opportunity, we think. We said what they do, boring business, but what are the fundamentals? Well, Q3, revenues increased 64%. Tremendous increase in revenues. Gross margins were up to 30% from around 23%. So that's why you saw earnings jump up fourfold from 2 cents in the same period last year to 8 cents. So you see a stock go up 300%, but its earnings went up fourfold. So it actually, the earnings accelerated faster than the stock has so far. It still offers some value then. Valuations, we estimate this year, or 28-19, about 41 cents. 16.5 times would get you to 675. And the market trades at 18 to 20 times. So this is valuing it at under the market, and it's growing above. It could get a premium valuation at some point, and that would lead to a higher price. The next company we're going to look at, I got to go through these quickly because we've got not a lot of time today. Questor, QST on the TSX Venture. It is at $4. We did seminars just this last fall. We recommended this company in October at $2.22. It's trading at $4 today. We still think it offers value. $111 million market cap. What do? Essentially, in the U.S., at well sites, they have huge problem with flaring of gas environmentally. What this company does is its technology eliminates 99.99% of the noxious gases at the wellhead when they flare off. Tremendous technology operating out of Alberta, but primary operations are in Colorado and moving into some other areas. They just got a contract in Mexico, which was a surprise, but that has led to the price surging over the past few months. But we think it offers good value here. 9-month revenues were up about 39%, so tremendous growth there. 9-month earnings up to 21 cents per share from 11 in the same period last year. That's tremendous growth. Strong balance sheet. We love companies with great cash positions, limited to no debt. This company has $7.4 million in the bank, 28 cents per share. Won't have to go to the market to raise money. That's a great situation to be in. We estimate this year 29 cents. Next year 34 would be a base case scenario. So at 16 times next year, it's $5.75, trades at $4. That's a good lift from here. And that's a conservative target because, again, 16 is below the market the market multiple right now is at 18 to 20. So ViaMed Healthcare is the next company I'm going to look at, VMD. Price around $5.45. We picked up coverage on this company in May of last year at $3.90. $270 million or $207 million market cap. What do? Home medical equipment supply company, primarily in the COPD market, which unfortunately it's for end-of-life patients, provides a better quality of life, keeps them out of hospitals, provides them with better quality of life, and saves the hospital care system money in the U.S. Unfortunately, that is a growth market in the U.S. Play on aging demographics, great organic growth. And when I say organic growth, this company doesn't have to go out and make acquisitions to grow. They can just go out there and grow their existing operations. And that's all you see. The growth is just from adding more patients and moving into more areas. 38% growth in revenues. Sequentially, so from the previous quarter of the same year, Q2 to Q3, it was up 11%, so accelerating growth. Adjusted EBITDA rose to $4.1 million, 11 cents per share from 2.4, so great growth in EBITDA as well. Valuations, we valued at about 9 times EV to EBITDA. Those are complicated numbers, but anyways, suffice it to say, we'd say it's worth $7 to $8 from where it's trading right now, and that's at a low multiple relative to its peers. Sangoma Technologies trades at $1.20 right now, no yield, doesn't have a dividend, $65 million. What does the company do? Essentially provides VoIP phones. Great business, tremendous growth. We'll see the growth right now. In the last quarter, 81% growth in terms of revenues. Made a significant acquisition in the last quarter of last year. We like the growth going forward. EBITDA doubled. Operating income doubled in the first quarter of fiscal 2019. Those are the metrics we like to see. Its outlook for this year, $100 million in revenues. Little company with a $65 million market cap, $100 million in revenues expected this year, up from $57 million in the same period last year, or last year period. And $10 million in EBITDA is what it's looking for. And margins will uptick 2020. So 2019 growth, 2020 growth. Looking forward, we see growth. The stock market always looks forward. So that's what we see going forward on this company's growth. And we think it's trading at a reasonable price. We think right now its fair value is about $1.65 to $1.85, somewhere in that range. And it's trading at $1.20, so you have a lift there. if they hit these targets, it can go beyond. Finally, if you insist, because we're at a resource conference, I'm going to give you one company in the resource sector, and it pains me. But why? Because they're a miller, not a miner. So they mill gold. They have in Peru, they have a processing facility. Essentially, there's artisanal miners, small-scale miners that bring them. There's about 400 of them that bring them, and they just mill it. So that you don't have the deposit-specific risk here, which we like. The fundamentals, 30 consecutive quarters of profitability. You do not see that almost ever in the mining sector. They pay a dividend, 2.5% yield right now, it says right there. Cash on hand of $11 million, up from the same period last year of 4.8. There's no debt here. They just keep accumulating cash. They don't have to go to the market. We like that. Low multiple, 3.5 times enterprise value to EBITDA. That is a very low multiple. What they have to do is they need to start hitting their targets. They grew production slightly this year, but they need to keep growing it. And it's always going to be dependent upon the gold price. It's less than your average junior miner, but it is going to be dependent upon the gold price. If gold has a good year and they hit their targets, it's significantly undervalued. If gold has a poor year, that's the issue in the sector. So thank you, ladies and gentlemen. If you got any questions, we got a booth over here. And thank you very much.